What's up, everybody? In this video today, I want to talk about two stocks that I think are deeply undervalued that I own in my portfolio and that insiders have been buying. As you may have often heard, there's many reasons why insiders might sell. Put yourself in the position of an executive who owns a lot of stock in the company, gets a lot of compensation from this business. You maybe have stock options and grants, and you want to take a little bit of risk off the table. So what do? You're constantly selling the stock options that you're getting to get some cash, to have some capital that isn't tied to the success of the business. So while we might not like to see executives selling, it's typically not the bearish signal that some people might think it is. But the flip side of that, executives going out and buying shares of their company, there's really only one reason they do that, and that's they think they're going to make money. Buys by management are certainly a bullish signal, and also they align management more with shareholders. I want management to have my interests in mind when they're making decisions on how to run the company. So we're going to look at two of these businesses today, and as always, if you get value out of the video, subscribe to the channel. Now let's jump into it, and the first stock we're going to talk about is, again, Fiserv. This is my own website here that I'm building out, and if we just search Fiserv here, it takes you to a page. You can read about the company. I've talked about Fiserv a couple times. We're not going to do a deep dive here, but obviously, most investors are probably aware that their stock price has crashed quite a bit. The stock's down about 50% from where it was, and we're not even looking at where it was earlier in the year. Now, it was a pretty disastrous third quarter. I'll put my video where I looked at those results in the description if you want to check that out, but I think the stock has sold off too much. And yes, I have been buying here over the past month. This business is not going anywhere. It's not dead. Clover is not dying. Their legacy financial services business still produces a ton of money, and those banking clients that they have are very sticky. The company is still extremely profitable, about 30% operating margins. They're now trading for a 10 times multiple of reported earnings, but the story I think is actually better than that. These earnings, their net income, and also their operating income, it is depressed by amortization that they have from all the acquisitions that they've made. If you look at the cash flow, if we just look at their free cash flow yield, and I always focus on the adjusted free cash flow yield, which is free cash flow yield net of share-based compensation. So this is the actual cash profit that your business is producing after accounting for all of the capital expenditures that you are paying out to invest back into your business, and also after accounting for the share-based compensation, the stock that you're giving out to your employees. And a 15% adjusted free cash flow yield is insanely high. There are very few large established businesses that have metrics like this. Management is completely new. They have a new CEO. Quarter three was his first full quarter in that position. They also now have a new CFO, several new members of their board. I think the CEO just ripped the Band-Aid off last quarter and probably kitchen sinked their guidance a little bit going forward. Growth estimates and guidance were slashed a ton, but still they are guiding for growth. Yes, it's low growth. This is a company that has grown their earnings per share double digits for about 40 years. So are we going to see that going forward? Probably not. I'm certainly not assuming that, but I do think that it's possible the company outperforms the guidance they've given. Even if they don't, I think the company is too cheap, and I think it offers an excellent opportunity today. And speaking of offering an excellent opportunity today, that brings me to what I want to talk about in this video, which is that insiders have been buying. So on my site, we can see these Form 4s that are filed when insiders acquire or dispose of shares of the company. And we don't have one, but two insiders that are buying. So first we have Adam Rossman here, who we see acquired shares. And a lot of times when an executive acquires shares, it's because of stock options, and that's not a bullish signal. It's not a bearish signal. That's just neutral. It is normal operations of the business. But we see here under transaction code, we see code P, and that is for a purchase. These shares are not from some option vesting. He went out on the open market and purchased 7,900 shares of Fiserv. That's about $5 million worth of stock. And this isn't the only person who has been buying. We go to this next form right here. This is Paul Todd. He just came in as CFO of the company. Again, we see code P. These are not options. He bought these shares. He bought 17,000 shares at, roughly $62. So this is over $1 million of stock that he was just buying with his own money. These other filings here are just options. So this is what it looks like if someone isn't purchasing, but they acquire shares through stocks being awarded to them. We see here transaction code. This is code A. So this guy here, Kenneth Best, probably some options that vest it. But if we go down just one more, look at this one. Hey, here's another one. Lance M. Fritz bought 10,000 shares at a price of $65 a share. So the insiders are buying. No one seems to be selling or disposing of their shares at these prices. And just to take a quick look back at my base case, by the way, huge news. I recently made a major update to my Google Sheets add-on. To show it off, I'm just going to go to Deep Value Hunter, going to open the sidebar over here, and I'm going to get my new template. Yes, I would like to make a copy of that. And in our new sheet here, once you have my add-on, you just put in a ticker symbol like Fiserv over here. I'm going to hit load. Yes, I'm going to allow access. And we see the sheet is loading a bunch of fundamental information about Fiserv. We also have now a nice description of the company over here. We see where it's located, employees. There's a link to the website if you want to quickly get their investor presentations and other information. Obviously, I'm biased. I made the thing, but I think this is a great way to take a look at businesses and see what you could expect for a return on your investment. On top of that, I used to only support stocks that were trading on US exchanges, but now you can find stocks on pretty much any major global exchange. So if you want to look up Wise, which trades on the London Stock Exchange, I'll just search wise.l here, and we see information coming in. Nice description of the business. The price is showing up in pounds. We see our financial currency is also in pounds. If we want that to be in dollars, we can just switch to change financials to USD. And now the financial information is going to load in dollars, which may be nice for US-based investors, depending on what you're looking at. My add-on supports over 50,000 different stock tickers. So I think it's good value. Go to my Patreon link down below to get access for this, or if you just want more information, you can go to deepvaluehunter.com. Now, enough of the side tangent, shameless self-promo here. Let's get back to looking at Fiserv. This jump here in revenue is when they acquired First Data. That's Clover. That's a lot of their merchant services. We see that net debt has been going up. It jumped up on that deal. This is definitely something to keep an eye on, but the rates on this debt are actually quite low. I think it's acceptable. Again, link in the description for my last video on Fiserv if you want to know more of my thoughts, but just what I had in my base case in that video was 4% growth on the top line every year for 5 years. This is a slowdown, but pretty much in line with management's kitchen sink guidance. I'm going to bring their operating margin back a bit to 28%. I'm going to bring down their free cash flow margin, and I'm only going to give this company an 11 times multiple. This is basically about the cheapest the company has ever traded for, but I'm not going to assume any multiple expansion or any change in sentiment really in my base case, and I'm looking at an 18% annualized return on this stock over 5 years. That is more than a double on your money over this time. I think the risk reward is excellent at current prices. And yes, I understand when the price drops so much, that is when people feel fear. That is when people feel like risk is heightened. But as much as it might seem counterintuitive, I strongly believe that Fiserv is a less risky investment today in the 60s than it was a year ago when it was over $200 a share. You didn't hear many people talking about risk then. Now that the price is not even a third of what it was, now all people see is risk. But as always, this is not advice to buy this stock or any other stock. I just give you my opinion and I tell you what I'm doing with my money. Now, moving on to the second stock, this is another company we've talked about on the channel before. It is gambling.com. There is more inherent operational risk to this business. I said I don't see Fiserv going anywhere. The core business is going to keep on chugging for the foreseeable future, but gambling.com, there's more uncertainty. I don't know. This is a small cap company. Their main business is essentially affiliate marketing. They funnel customers to casinos and other operators, and they take a piece on that traffic that they pass along. I've given my thesis on them before. I don't think these price to earnings numbers are reflecting the true nature of the business. Earnings are depressed mainly due to how they're accounting for their acquisitions. If we look at the cash flow incredibly strong, and this is a company that has been growing. I think I'll probably change this chart on my site to flip around the other way, but we see trailing 12 months on the left, revenue has been going up. And yes, we see operating income, net income down a bunch, but again, that's due to how they're accounting here. This is a growing business that is very likely to be producing over $40 million of free cash flow over the next year. I'm expecting forward free cash flow yield to be over 20% for this company. The fear here is that AI, LLMs are going to be a threat to their core business model, which has been based on Google SEO in the past. Now, in their financials, we don't see that the business is shrinking. And in fact, the CEO said that their core business is growing. In spite of headwinds, the marketing business is still improving. In a recent interview, the CEO, Charles Gillespie, said that the fourth quarter has started off stronger than they thought. October is showing improvements over September, and he basically signaled in the interview that, he expects that they're going to beat their Q4 guidance. And the CEO is putting his money where his mouth is. He is buying stock. Now, you won't see that in filings here because they don't have to file the same SEC filings as other businesses. They are not headquartered in the US. They are headquartered in Jersey, which is a little island in the English Channel here. So we're not going to see insider trades in effectively real time. They don't have to disclose this until I think 45 days after the end of the quarter. But the CEO wrote on X, "My family office has acquired 351,000 shares in gambling.com, more than 1% of the company, taking my stake from under 10% to over 11%. I believe the current valuation is completely disconnected from reality, and I'm delighted to pick up shares at these levels." And then he goes on to say that he thinks other members of management are buying too. I'm sure he has insider knowledge of that, of course, but you're not going to see that because they're a foreign company and they don't have the same filing requirements. So it's great to see the CEO putting his money where his mouth is, aligning himself with shareholders. 11% ownership in the business is quite high. Again, there is real operational risk to this business, more so than I think with Fiserv or certainly a lot of other larger companies. You should check out my previous videos on this company for a more in-depth look. But for me, I'm okay making this holding a small position in my portfolio. I think for better or worse, there's a lot of natural tailwinds to online gambling and the online betting business. We saw Missouri just legalize online sports betting last week. We're probably going to see other states in the US roll that out. I think there's going to be more of a shift to online sports betting, and gambling.com is, I believe, going to benefit from that. If my thesis on the company is correct, I think that the upside here from today's prices is quite large. So for me, again, not advice for anyone else, but just for me personally, the very large upside reward potential justifies the risk for a small position in my portfolio. And that's all I have for you guys today. I haven't posted much this week because mostly I've been working on this add-on. I think I've made a cool product. I think my website, when I'm done building it especially, is going to be a cool product as well. So if you want access to these things, follow me on Patreon. Link to that will be down below. If you have any thoughts on the companies we talked about today, leave that down in the comments below, and I hope to see you all in another video.